Bloomberg. Live from Bloomberg's World Headquarters in New York, it's a threefer. I'm Julie Hyman.
And I'm Joe Weisenthal.
And I'm Oliver Rennick. We are 30 minutes away from the close of trading here in the U.S.
U.S. stocks are edging higher on a quiet day of trading following the holiday weekend. The Dow flirting once again with 20,000, the S&P 500 extending its monthly gain, and the Nasdaq poised for another record close.
But the question is, what'd you miss?
Stocks edging higher as markets resume trading after the holiday weekend. Major averages giving up some of their earlier gains, but the Dow still has been flirting with 20,000. Large cap tech stocks like Apple and Amazon lifting the Nasdaq to another record. More from Bloomberg's exclusive interview with Bank of America Chairman and CEO Brian Moynihan. After several years of consolidation and unwinding of assets, he tells Bloomberg's David Weston whether there is more to come. And Donald Trump says the world was gloomy before he won, and now the market's up nearly 10%. We'll examine his claim and take a look at the markets post-election. Let's take a look at where the major averages stand as we head towards the close. Bloomberg's Abigail Doolittle is standing by as we've got this little lift today.
Yes, we do, Julie. We do have stocks rising right into the close. Small gains for U.S. stocks, including the Dow, S&P 500, and Nasdaq. We do not have, though, Dow 20,000. Everybody's still waiting for this important psychological milestone. It does not appear that it's going to come today. The Dow is about 50 points within Dow 20,000, but it is kind of quiet, tired trading, so it's unlikely it happens by 4 p.m. What we do have, though, in the Nasdaq, as you mentioned, record highs, both on an intraday basis, an all-time high. We also have the Nasdaq on pace for a record close. The S&P 500 had been there earlier, but right now the S&P 500 is not on pace for any records. Now, where we have unabated strength, the commodity complex, the Bloomberg Commodity Index is up 1.5%, having its best day this month. Oil, of course, is up nicely, up 7 days in a row, the longest winning streak since the end of August, ahead of the OPEC and non-OPEC supply cut deal of 1.8 million barrels per day that starts this Sunday. We also have strength in wheat, up about 4%, and it looks like there are some demand pushes there, tailwinds there, plus a rebound from last week's weakness. And then finally, we do have gold higher by 0.5%. Now, gold very recently has been interesting. It's been down since its peak. When we take a look at gold on the year, the most recent trading action has been more bearish in nature, down about 20% from that peak. But on the year, look at this. Gold is actually up 7%. And perhaps even more surprising, this is gold's best year since 2011. Not so much a reflection of that gain. 7% is nice, but not massive, but more a reflection of the bear market out of that 2011 nominal peak of about $1,921 per troy ounce. As for what could be ahead, we hop into the Bloomberg and we take a look at hashtag BTV 5218. This is a 5-year chart of gold. Here we see that downtrend, that bear market in gold, and we have it within a channel. Right now, gold is dipping below the midpoint support of that channel. It appears to be trying to climb higher, and very interesting, on the bottom, we have the RSI, or the Relative Strength Index, a momentum indicator that many investors use. It had dipped below 30, which is the buy signal. It's creeping above 30 right now. Perhaps this signals that we will see some strength ahead for gold in 2017.
Thanks so much, Abigail. I did not realize it had done so well this year. Joe?
What'd you miss? Shares of Bank of America have been on a tear post-election, up more than 30% since Trump's victory. Chairman and CEO Brian Moynihan sat down with Bloomberg's David Weston for an exclusive interview at the bank's office in Boston. They discussed the company's consolidation and future growth prospects.
When I sort of interviewed for the job of being CEO in the latter part of 2009, I had a list, and I literally had a list of all the things that didn't fit with a core franchise, a core consumer franchise, a core wealth management franchise, a core commercial banking franchise, and a core capital markets franchise that came through a lot of the enterprises we acquired. And we needed to deal with over time. And so I showed the board that, and the idea was that if we took the risk out of those businesses, if we took the capital out of those businesses, we took the complexity out of those businesses, you could tighten the company down. And so we went from $2.7 trillion in assets to we're about 2.2 now. We sold maybe 60 operating divisions. We went from credit card operations in 5 or 6 countries to, if we complete the last sale, which we'll complete over the next 2 or 3 quarters, down to 1 country. But all of it was based on a basic principle that our basic business model was all our businesses operate in the United States, and we have 2 businesses which are global, our corporate investment banking business and our markets business, because large companies are global beings, and we have to be around the world to serve them and serve them well. And so, but I had that list done, and it's done now. We're largely done with it, but it's taken a long time to kind of finish it all.
So nothing left on the list.
When you flip to the other side, it is actually illegal for us to buy a depository institution in the United States. Not a lot of people know that. It has nothing to do with Dodd-Frank. It was in the Regal-Neal or whatever the bill was before that. So if you have more than 10% of deposits, you're not allowed to buy. Makes my life pretty easier because I never have to worry about that. So to grow our banking business in the U.S., it has to be organic, and that's why we're opening branches in places like Denver and Minneapolis, why we'll open branches in other cities over the next few years to round out the markets that by happenstance we weren't in. It's why we built new branches in places like New York where our structure wasn't as strong as we want, Philadelphia. So it's all organic, and so more financial advisors, more U.S. trust, what we call PCAs, private bankers, more commercial bankers, more people in the branches serving customers, and more branches. By the way, we're in a ton of money in technology because we have to be organic growth. We can't buy anything. And so think about a company which has been around in various parts for 200 plus years, and all the acquisitions that arrived at the scene, and how easy my job is relatively because I can't do it. And so now all I have to do is think of every day how we can make the company better organically. Now, it's a huge company, and that burden's not small, but it's kind of an interesting place to be. But it's illegal, so it's a very easy question to answer.
That was Bank of America Chairman and CEO Brian Moynihan speaking exclusively with Bloomberg's David Weston.
All right, I'm going to check out some financial stocks since we just had Moynihan there. And obviously, there's been a lot of interesting things going on with the sector. Let's dive into my terminal real quick because I'm going to look at what's happening on the earnings space. We know there's a lot of expectations for next year's earnings across the S&P 500. Basically, what this is showing you is that the same thing exists for financials, but maybe not quite as much. The top panel here is looking at the blue line, which is the financial sector, current price to earnings, and the white line is what's expected in terms of the Bloomberg estimate next 12 months. You can see the P level coming down a little bit. And then the actual earnings expected are on the bottom there. You can see that big jump in September is when we shifted over to looking at next year's end of year earnings. So about $25 per share, or rather for that entire index, the financial index, which is more than about a fifth of what's expected for the S&P, which of course goes with the group's weighting. But basically the story here is that, yeah, they've rallied quite a bit, but they are one of the sectors here that are poised to supposedly have, at least analysts say, quite a bit of growth next year, like 12, 13%. So if those earnings can get to where they are, you'll actually see the multiple in that top part come down a little bit. So maybe it's not quite as fanatical as.
And how much of that earnings optimism is just about more economic activity? I know the yield curve steepening is a big part. Deregulation. Do the analysts, do we know why they're expected to have stronger earnings?
Well, there was generally a assessment that higher yield curve and rates going up next year was going to be a boon to the banks even before Trump. And now that's all gotten translated forward. And then I think it's deregulation as well. Julie's got an interesting thing about the actual companies because there's only 2 companies that are down. And
since the election in the financial group, so if you look at MRR on the Bloomberg, looking at the S&P 500 financials, you'll see as a group they're up 18%. So that's no surprise, right? We know the financials are the best performing group. What's interesting is how many of them are up. Only 2 of their components, and there are 63 of them are down. It's Moody's and S&P. Some of the insurers are some of the weaker performers, and the exchanges, interestingly, ICE and NASDAQ were on the list. And then you've got the community banks, the regional banks up at the top. Zion, Citizens Financial, Regions Financial, Comerica. Yes, Goldman Sachs is on there, but it's interesting that it is these regional banks that have done the very best. What's also interesting when you look at these earnings estimates is you have the sort of financial specific stuff like the yield curve, like financial deregulation potentially. You also have what many strategists have been doing going into next year is just looking at the whole S&P 500 and raising their earnings estimates based on a theory about tax cuts, corporate tax cuts just broadly, right? So you got to put that on top of this as well.
You know what I think is interesting is the fact that the only two companies that have declined are Moody's
or the ratings
and S&P. The ratings. So I guess we're just going to be in this deregulated era, and nobody's going to care about ratings anymore.
And it also just speaks to their business models are sort of fundamentally different than these yield curve specific ones. It also shows, you know, as you're saying, tax cuts being such a pivotal part of why people are optimistic, why multiples have gone higher. How much is riding on the line of the specific tax cuts? We know that they're theoretically coming if they can get them passed, but we really don't know much about what will be in them yet. Coming up, find out if one of the street's biggest bulls, Fundstrat's Tom Lee, is feeling positive about 2017. This is Bloomberg. What do you miss? Fundstrat Global Advisors Managing Director Tom Lee joined What Do You Miss earlier this month to discuss the shift out of the equity market and his 2017 outlook.
Households saved $7 trillion in the last decade, right? $7 trillion. They took $2 trillion out of stocks. So not only did they save money, they liquidated equity. So you have to think the next 10 years is mean reverting. Households might save another $7 trillion, but do they put $4 trillion into the stock market? You know, that's monstrous inflows.
Why does it mean reverting? I mean, could there be a demographic reason why people just have to reduce their risk over time? U.S. population is going to keep getting older for a while. Is there a reason this trend just couldn't keep going on for several years?
I mean, you can do it based on the saver, or you can do it on financial markets. Last year, there was $1.5 trillion of new bonds issued in the U.S., okay, across all fixed income classes. That number is going to shrink this year. Let's say it's, you know, 1.1 trillion, right, because deficits are shrinking and agency outstandings are shrinking. But the coupons paid on existing bonds is going to be like 1.4 trillion. There's a shortage of bonds anyways. I mean, if people keep buying and allocating to bonds, interest rates are going to go to zero in the U.S., even with inflation. So there's a mechanical restriction. They just can't buy. People just can't save and buy more bonds. So now stocks are a lot cheaper, right? Cisco pays a huge dividend, bigger dividend than its cost of debt. So I think it's easy to see how the money gets into equities just to generate income.
One of the big conversations, I think, of the past month or so since the election has been the crop up of dispersion within the marketplace. Stocks moving independently from another, sectors are moving in opposite directions. How do you view that in your strategy when you think about whether or not that brings people into markets? I feel like one could make the argument that, hey, if you see stocks going in different directions, you think active management does well, maybe some of that money comes into stocks. Yeah. Or is dispersion and flows related at all?
They should be related. Dispersion should be correlated with active management performance. I don't know if it's going to be because it really depends on the experience level of a manager. I mean, the reality is the one challenge, and I've seen it with our clients this year, because people have only been using one playbook, which is growth, stocks, China, healthcare, consumer, every pullback they've been trying to buy 2015 greatest hits. And it's been hurting them, right? Like I'm sure you get guests talking about, hey, I want to buy healthcare because it's gotten reasonable. Healthcare's led by 4,000 basis points cumulatively over the last 5 years. Right. It's one of the biggest, in the cycle of healthcare returns since 1920, it's one of the biggest periods of outperformance. It's not going to keep outperforming.
So we've seen, obviously, some post-election shifts in what the leadership of this market looks like. Tech has kind of been pretty mediocre since the election, but the financials have been obviously on a tear. Another example of the staples, which people had loved for a long time, not doing so great. Yeah. Do you expect some of these new shifts to last for a while?
Yeah, I mean, I think it's I think you could almost count on it because, you take any of these industries, and we've been looking at 104 now. So we're really trying. I think next year is a lot more about not getting, it's being very zip code specific next year. Every group's mean reverting.
What does that mean, zip code specific?
Well, instead of looking at, let's say that value and growth is time zone, right? Eastern and states are more like sectors. Zip code is what you call the GICS 4. On Bloomberg, I think it's about GICS 4 next year. And these groups they're mean reverting. They just look like big sine waves. You want to buy the bottom of the sine wave and avoid the ones at the top.
And speaking of buying the bottom of the sine wave, are you still buy the dip? Is that, even though perhaps there's some adverse, headwinds here, market goes down 5%, market goes down 7% in the next, 6 months. Do you buy on that?
Yeah. Well, I mean, I'd say for sure the next 4 years, 5 years. Look, the lesson everyone should have learned by now is you got to buy the dips, okay? But I'm sure there's going to be a time within the next 5 years where one of these dips is going to be preceded by something warning you it's a wallop. And maybe people thought the wallop was going to happen this year. It hasn't happened, but it'll come.
That was Tom Lee, Fundstrat Global Advisors Managing Partner.
It's time now for the Bloomberg Business Flash, a look at some of the biggest business stories in the news right now. Argentina's Alfonso Prat-Gay has been forced out as the country's finance minister. He was on the job for just a year. Prat-Gay and the country's president, Mauricio Macri, have had disagreements over economic policy. 3 Chinese hackers made more than $4 million in illegal profits after hacking the servers of top law firms in New York. The U.S. says they bought shares in at least 5 companies before deals were announced. Some of the transactions involved chipmaker Intel and business services company Pitney Bowes. The SEC filed a parallel civil complaint and is pushing to freeze their assets. And the initial excitement surrounding the mobile release of Super Mario Run may have been short-lived. Less than 2 weeks after it launched on Apple devices, Mario is no longer the highest-grossing app in any country. In terms of free downloads, it's still on top in 68 countries, but that's down from 138 on December 17th. Users who want to move past the first 3 levels have to pay a $10 fee. And Amazon is calling this its best holiday ever. The world's largest online retailer says it shipped more than 1 billion items through its Prime and fulfillment services. Plus, Amazon reported record sales for Echo speakers based on its own Alexa voice recognition software. And that's your Bloomberg Business Flash update.
Up next, we're going to be looking at some charts showing how bonds and equities have changed since the election. We'll walk you through it. This is Bloomberg. Julie Hyman. What'd you miss? Well, those betting on the stocks that they think will benefit the most from a Trump victory may have done better just to bet on small caps entirely. Morgan Stanley was out with a basket of 54 stocks that are so-called long Trump trades, those that are seen as benefiting the most, perhaps through tax cuts or through their various sectors. So here's how they've done since the election. It's the white line. So obviously we've seen a rally there, and a rally of about 11%. However, the rally in the Russell 2000 has been larger, closer to 16% here. So the Russell 2000, the conventional wisdom goes, comprised of small cap stocks, which are seen benefiting because they're domestically oriented. They can benefit from those tax cuts and also from the various fiscal stimulus policies, again, presuming that indeed they are going to be enacted. So just interesting comparison there. Of course, past performance, no guarantee of future performance. So we'll see if this trend does indeed continue going into 2017.
Also very interesting how the long Trump basket basically isn't even above where it was 5 days after the election back there on the 11th, whereas the Russell has rallied significantly since then. Another area that's done very poorly since the election is emerging market bond ETF. If you look, this is a chart, this is a look at inflows from the EMB ETF. Go here, you see lots of deep red bars after November 8th. That's sort of the double whammy for investors in this post-Trump environment. Obviously, anything bond-related is not in favor with these higher rates that we're seeing. Fixed income is out, and emerging markets are, of course, out. Sort of the flip side of what Julie was saying. Everybody wants domestic, U.S.-focused. Anything other than that, not doing so good. So since that election, if you're in that double combination of emerging markets and bonds, everybody is rushing for the exits. You can see all those bars right there.
I'm going to go real thematic, and I'm going to combine the two because here's what's interesting. Getting long the Russell 2000, that's basically getting long riskier assets, but then people are doing that within the U.S., but then they don't do it in terms of regions. They don't get long the riskier regions because nobody's putting money into emerging market stocks either.
Right.
All right, I'm going to talk about bonds too, treasuries actually. Looking at basically what's been a couple of pretty bad months, November in particular, a real bad month. This is the return using the Bloomberg Barclays Index. This bar dropping down there at almost 3%. That's what we know, the sell-off that we've had in the 10-year. Not a great situation. Obviously, there's about 6 months now that Treasury has been losing money. Of course, the month of November was actually the worst since 2009. Not too hot. They are taking some of that money and they're putting it into stocks if we've seen some inflows. But I guess it'll be interesting. I think what's interesting here is that even though you've had a sell-off that's the worst since 2009, it hasn't really shaken up, broader markets that much.
It's surprising. You'd think that with so much pain, it would be this sort of, rates, multiples coming down. But everyone's saying it's a sell-off for the good reasons because it's about growth and inflation. And so as of now, not really having a reverberation into U.S. equity.
Yeah.
What's also interesting to me, looking at all of these various trends, is how crowded they have become. And I believe Danny Berger has it's Julie Verhage that has a story out on the Bloomberg today talking about some of these very crowded trades that we've seen since the election. A lot of people we talk to have the same ideas.
It's a very specific rally. It's very U.S. focused. It's very equity focused. Any sort of diversification, bonds, emerging markets, trying to create a basket hasn't done so well.
Right, and even when you look at within asset classes, equities, for example, the unison came sort of very quickly, right?
Yeah.
Because nobody was even really talking about how much financials are going to rally. We were. But then all of a sudden, now you have everybody saying, oh, maybe it's not the defense, maybe it's more the financial companies, maybe it's energy and all this stuff. So there definitely is a lot of unison that takes place, and it's never really a great thing.
No, it usually doesn't turn out so well. We'll see what happens. I'm looking forward to 2017. The market close is coming up. Here are the major averages, less than 4 minutes until the close, with the NASDAQ on track for a record close in today's session. This is Bloomberg. just moments away from the closing bell. What'd you miss? Stocks edging higher on this quiet trading day. The major averages giving up some of their earlier gains. Dow 20,000. We're still watching for it. The index coming within 20 points of that mark today. Treasuries falling amid soft demand for an auction of 2-year notes, and crude climbing for a 7th straight day. The Bloomberg Commodity Index having its best gain in nearly a month. I'm Julie Hyman.
I'm Joe Weisenthal.
And I'm Oliver Rennick.
We want to welcome our viewers who are tuning in live on Twitter. You can watch our closing bell coverage on Twitter every weekday from 4 to 5 p.m. Eastern.
And we begin with our market minutes. As we talked about, we're watching stocks today. The Dow getting a little closer to 20,000. The Nasdaq's closing at a record.
It's asymptotic at this point, right? We just keep moving closer and closer, but we're never going to get there.
What now?
Asymptotic. We're taking a half step closer every time, and we're never getting there.
You guys are such nerds. I love it.
But I want to look at what's happening with a few sectors. There are a couple of interesting moves on the sector space today. If you look throughout the S&P 500, there was early strength in energy, but then it faded. What ended up leading the way here was tech, which did pretty well on the back of a few good companies that performed, in particular NVIDIA. Then you also had some gains in some of the big weighted stocks as well. Consumer discretionary did pretty well after some of the consumer confidence numbers that came out this morning. Energy ended up about 20 bips higher. Financials, a little bit of weakness today, but overall the sector scene was pretty good. Flip it over, take a look at volatility real quick, because people have been talking about this. Even though the VIX is dreadfully low on the month, it ticked up a little bit today. So you're seeing a little bit of increases in the VIX on even these days where we are climbing higher. I think it just speaks to the absolute level of the VIX, which is very low. And then finally, let's jump into my terminal real quick. We're going to check out the SVS function sector volume. This is pretty great because it kind of highlights the only places where the market was trading at a higher volume, and those are the green spaces. NVIDIA was at a higher volume. You had Red Hat Inc. over here. You had Mattel, some of these consumer discretionary, Starbucks, but ultimately a lot of red here, and that means that everything was very slow and thin trading today.
Let's take a look at the government bond market. Not a ton of action. Real quickly, U.S. 2-year and 10-year higher. So kind of the same theme we've been seeing for a while. Not a dramatic move, but this sort of the upward pressure on rates continues. And that's all about there is for government bonds. And on the commodity front, the big mover today, zinc, down 2%. Of course, zinc being seen as a proxy for both industrial activity in the U.S. and China, probably more really China than the U.S., down 2%. Gold, little change, up 0.5%. And NYMEX crude getting a nice bump. It was below 50 not long ago, but now getting close to $54 a barrel.
And taking a look at currencies as well during the session, we did have the dollar gaining a little strength versus the Japanese yen, the euro unchanged versus the dollar, and the pound falling back just a little bit. If you look, since we've been talking so much about returns since the election, I've been looking at some of the major currencies since the election on the Bloomberg at WCRS, and these are all the currencies versus the dollar since the election. So the dollar's up versus all of these 16 currencies, faring the best versus the Mexican peso, the Japanese yen, the Australian, and the New Zealand dollar. The South Korean won, which we're going to talk a little bit more about, is also on that list, but it is remarkable just how widespread, how the breadth has been of the strength in the dollar.
And of course, you see the pound the best performing there after having got clobbered already earlier in the year.
And still down.
And still down, still down.
Those are today's market minutes.
All right, let's stay on currencies. Kit Jukes, global strategist at Societe Generale, joins us now from London to share his top trades to kick off 2017. Kit, the first question has to be in reference to what Julie just showed, the dollar. It seems like everybody's bullish on it. You very rarely hear a negative take on it. What does the future have in store for the dollar?
I guess I think of Icarus, the Greek guy who made himself a set of wings held together with wax and ignored his father and flew too close to the sun. Sometime in 2017, probably after the French elections in May and before the middle of the year, the wax is going to start to melt. So we're going to start the year with the dollar going high. It's going to make it through 120 yen. It's going to get back down to 120 against the pound, and we'll probably see parity against the euro. But I don't think we can't keep on doing this. Unless you can find a way to generate 3.5% real GDP growth and I don't know, 3 or 4 rate hikes next year, I think the dollar's nearly done.
So, Kit, those 3 or 4 rate hikes, the market right now is pretty convinced they're going to happen. So is this a situation where the expectations are just too high for the dollar and they need to be tempered, or is there going to be some kind of shift that actually happens across global markets that will drive it fundamentally lower?
I think, I mean, the first piece is if the dollar keeps on going up, that at some point it's going to start feeding through to Fed thinking. We're all sitting here saying tax cuts and spending increases coming out of the United States and some inflation. You get a stronger dollar, and it takes a while for the fiscal easing to feed through. And you know, I would have said, you know, U.S. real growth is going to be 2 point something or other next year, not more than that. The unemployment rate can't fall that much further. But if we don't get a lot of inflation coming through, you know, we started 2016 thinking the Fed was going to raise rates a few times. As we remember, they did it once. I would guess 2 rate hikes is what we'll get next year, 3 at the absolute most, 2 more likely.
And so, Kate, when you look at what's going on in the U.S. versus what is happening in Europe, does that mean that then if the dollar ends up sort of rolling over second half of the year, that's going to be good for the euro and the pound, or are they going to have a tough time of it as well?
I think it'll eventually be good for the euro. Look, I was in the States for the U.S. election and the next 10 days afterwards. You know, we talked about politics more than economics after President-elect Trump arrived on the scene. And I don't think I can persuade a European investor to buy the euro this side of the French presidential elections. You know, Americans have seen the wind of populism blow through and don't want to risk the chance that Marine Le Pen ends up as president of France. So, but if that doesn't happen, and if we don't get more populism, the euro is very cheap. It's only held down here by huge outflows of capital from European investors recycling a huge current account surplus. I think the euro's weak point comes, yeah, you know, probably within a week of that election on May the 7th, and then the danger is we're all short, we're all bearish, and we're all covering.
Yeah, you know, speaking of Europe, when we talk about Europe, almost it's entirely dominated by politics. This year it was Brexit in Italy. Next year it's the French election and the Dutch election. There's almost no talk about the underlying economic conditions, and I've seen people argue that they're a lot better than people realize. I have on my chart here a chart of current job seekers in France, for example, has fallen to its lowest level since 2014. Unemployment is falling, labor market is tightening. When you talk to people, do they realize that a lot of the data out of Europe has been getting more positive?
Some people realize it, quite a lot of people ignore it. I could throw in the fact that there's a really high correlation between the direction of U.S. growth and European growth. You know, so if the U.S. economy does well, Europe does well. And the whole, you know, global bond market sell-off, for example, started in the summer with better data. So, yeah, you know, the European economies, it's not flying. It's trundling along in the way the European economy does. But the downside risks to growth really aren't there for next year. The risks are all political at this point in time. And at some point, that feeds through to, or fades, you know, we get certainty one way or the other.
So going back to that French election and going to May here, as you said, if people are sort of caught trying to pile into the euro, if there is a non-populist outcome of that election, ahead of that, I mean, is there any way to sort of tactically play it without taking on too much risk?
It's harder for people. I think that's what they're trying to struggle with. Most people are still selling. I like buying the Swedish krona, which I think I said to you this time last year when it was a bad idea. I had some good ones this time last year, but that wasn't a good one. The Swedish economy is doing much better. The economy is very strong. The current account surplus is huge. The central bank have got negative interest rates and bond buying at the same time as they have 3% real GDP growth because they don't want their currency to go up. As inflation returns, I would bet that the Swedish central bank starts to rethink, and finally they can start seeing a stronger currency. Before that happens, I have to go and spend some time in Stockholm.
Kit, one of your trades looking at gilts in the UK, not just shorting or going long in particular, but basically expecting a shift in the shape of the curve there. Tell us about what you think is going to happen to their yield curve across the pond.
Yeah, so our yield curve's too flat relative to yours in particular and relative to the level of short rates. So, you know, typically when we see interest rate expectations this low, you get a steeper yield curve. What we have here post the vote to leave the EU is uncertainty about the political outlook, a dreadful fiscal outlook, frankly. The country's finances are not in great shape. And at the same time, the front end of the curve anchored by monetary policy that's buying insurance for what's going to happen. And finally, the prospect of higher inflation because of the fall in the pound and particularly the rise in sterling oil prices that we've already seen. Throw that all together, and I don't really understand why the longer end of the UK yield curve isn't higher in absolute terms and isn't higher relative to the US in terms of the shape of the curve.
Is the worst over for the pound, or is there still more pain ahead?
I think it's going to be fairly dull. I mean, the pound has done all of the heavy lifting after that vote in June. As you said earlier, you know, the pound stabilized since the US election, but boy, did we get hit. Boy, did we get hit in the first half of the year. There are still currencies I think will do better. The Swedish kroner, I think, will outperform the pound, but you know, I don't think sterling is a big mover. If the euro goes down 5% against the dollar on European politics, the pound will go down 3% against the dollar on the same thing. We're really waiting to see how the economic data pan out at this time. I'm vaguely hoping that the pound's going to be more boring, and my focus ought to be to switch more towards what happens to the interest rate market.
All right, Kit Jukes, global strategist at Societe Generale. Stay with us because we're going to talk about the yen and the UN next. This is Bloomberg.
I'm Taylor Riggs. Let's get to the first word news this afternoon. Shinzo Abe is now the first Prime Minister of Japan to visit the USS Arizona Memorial and the first Japanese leader to visit Pearl Harbor with an American president. Abe began his trip to Hawaii by placing a wreath at a military cemetery. Then he and President Obama held a formal meeting at Camp H.M. Smith. That's a Marine Corps installation and headquarters of the U.S. Pacific Command. They shook hands but made no remarks. President-elect Donald Trump has nominated Tom Bossert to be Assistant to President for Homeland Security and Counterterrorism. Bossert was a former Deputy Homeland Security Advisor for President George W. Bush. His responsibilities will include advising Trump on cybersecurity matters. And one of President-elect Donald Trump's main advisors on U.S.-Israeli relations will be his special representative for international negotiations. A statement from Trump's transition team says attorney Jason Greenblatt has been named for the role. For 2 decades, Greenblatt has worked for the Trump Organization. He currently serves as its executive vice president and chief legal officer. And actress Carrie Fisher, who found enduring fame as Princess Leia in the original Star Wars movies, has died. Fisher had been hospitalized since Friday when she suffered a medical emergency on board a flight to Los Angeles. She made her feature film debut opposite Warren Beatty in the 1975 hit Shampoo. Carrie Fisher was 60 years old. Global news 24 hours a day, powered by more than 2,600 journalists and analysts in more than 120 countries. I'm Taylor Riggs. This is Bloomberg.
Thanks, Taylor. Let's continue our tour around the world, our currency tour with Kit Jukes. He's global strategist at Societe Generale in London. Kit, we've been talking about a little bit about the dollar. We've been talking about European currencies. I want to turn to South Korea there because you're looking at the dollar-won pair in particular. And we've seen the dollar perform well versus the won, like we've seen it perform well versus most currencies. Do you think we'll see that turn that you were talking about also effective with that pair where the dollar perhaps won't do as well in the second half of the year?
I think it takes longer to, particularly the won, the Taiwan dollar, and it's driven by China. So the Chinese authorities are letting the currency weaken in an orderly fashion at this point in time. So it's fallen about 7% so far this year. So it's a pretty slow, steady decline. It's gone up an enormous amount over the last decade. So it's an expensive currency, slowly coming down. If anything, they're in danger of losing control. Their foreign exchange reserves.
Sorry, just to be clear, we're talking about the yuan now, right? The Chinese currency.
I'm talking about the Chinese are in danger of losing control over their slow and orderly decline of their currency as their foreign exchange reserves fall quickly. This is relevant for Korea. It's the most affected economy by what happens to China. They're next door. They're huge trading partners. They're competitors. They have a slow economy. They have a very rapidly aging population. They have a certain amount of political trouble. But if their biggest trading partner on the one hand is weakening its currency, and their other biggest trading partner, the Japanese, have weakened their currency extremely quickly over the last 6 weeks, they're definitely caught in a difficult place. And the Chinese side of it is important because that's a separate story. I think the yuan will probably go on weakening through most of next year, separately to what the dollar's doing against, the euro or the yen or the pound or anything else.
Kit, I want to just put a visual here for our viewers to what you're talking about. If we jump into my terminal real quick, this is basically showing the Korean currency versus the Chinese currency. You look at what on a year view, and you can see since July, both of them weakening versus the U.S. dollar. You take it back a little further, you take it back a decade or so, and suddenly it looks a little bit different. I'm wondering, to you, then, does this show you that the Chinese currency right now is still more overvalued?
It does. I mean, I think the Chinese currency is more overvalued at this point in time. It's also more politically sensitive to the relationship between China and the United States. It's more sensitive generally to what the Chinese might do in terms of trying to put on capital controls to stop flight, which would make it difficult to trade. So although it looks to me as if the yuan is the more overvalued currency that can weaken most, I would rather sell the Korean won because I think it's going to react more smoothly. In other words, they put capital controls on in China. Anybody who's short the Chinese yuan is going to find that difficult if they do it aggressively, but the Korean won would fall on that. So I feel a little bit more comfortable trading the neighbor rather than trading the political animal that I find, I'm not always confident I can predict what they're going to do politically.
Let's talk about the yen. There's an argument to be made that the yen has a lot more to fall thanks to the Bank of Japan and its efforts to cap the long end of the JGB curve. If rates are rising everywhere and that's not happening in Japan, then you could see significant weakness due to that yield gap. What do you make of that story? Where's the yen going next year?
It's going to weaken a little bit far further. I mean, it's weakening so quickly, to my mind. The trouble with the yen is that fair value for dollar yen on most of the kind of models that I've ever been able to build is somewhere between, certainly between 100 and 110, around about 105 is a decent guess. So they've got it really cheap, really quickly, which is back to where they were at the beginning of this year. Now, they have a policy of keeping longer-dated yields down that is exactly the right policy to weaken your currency during this bond market sell-off. It's a great policy. It's very good for their equity market. But I would guess that dollar-yen peaks out at 120-something. 125 seems like a good guess. 130 feels like a stretch. At that level, this starts to be an incredibly undervalued currency, which is what happened at the beginning of this year. And we know what happened then. It just ran out of ability to fall, sat around and went sideways for a few months, and then rallied really fast. So I get less enthusiastic about the selling the yen when dollar-yen gets above 125. And at the rate we're moving, I don't even know how soon that happens.
And, Kit, another one of the pairs you're looking at, another one of the rapid moves that we have seen has been in ruble yen or ruble pound is another that you're seeing. Obviously, you also have the sort of geopolitical spice thrown into this trade as well. What are you looking ahead at for ruble for next year?
I think the ruble can continue to do very well. It's the currency in the world that is the single currency most correlated to the price of oil. So, you know, if the oil price goes up another 10%, the ruble will get stronger. They have political stability, and they have at least the perception of the moment of a brighter geopolitical environment for them, although they still have sanctions. They have an economy that I think it would be fair to say is not getting worse. But they are, you know, the ruble is fighting it out tooth and nail with the Brazilian real to be the winning currency of 2016. So at some point, this sort of fatigue sets in. I was in Moscow last week. It didn't feel like I should be buying anything more than a few souvenirs. It was, you know, I paid a lot more for my cup of coffee at Starbucks Moscow than I do around the corner from your office.
Maybe buy one of those big furry hats while you're there. That seems like a good investment.
It'll come in handy in Stockholm
I bought four
as well.
of those. I bought four of those.
Kit, thank you so much. I don't think there's a currency we didn't cover. Kit Jukes joining us from London with SocGen.
Coming up, more Americans are upbeat about the economy than they have been in 13 years. U.S. consumer confidence jumping to the highest level since 2001. But there's a generational gap beneath the numbers. This is Bloomberg.
Let's take a deep dive into the Bloomberg. And a reminder, you can find all the following charts using the function at the bottom of the screen. First up, consumer confidence came out today. The Conference Board's reading for last month. And it's interesting here because if you look specifically, the Conference Board asks people all kinds of individual questions as part of its survey. One of the questions is, will stocks go up? And
Obviously.
we saw the biggest increase in the number of people who said yes since November of 1998. This isn't necessarily a shock here, given the rally that we've had in the wake of the election and given the talk about the rally, probably more importantly, in the wake of the election, given all the talk about 20,000. The question, however, and we're going to talk more about this with George Perks of Bespoke in just a moment, is when you see sentiment get to those kinds of levels, do you start to get worried?
This is just such an astonishing chart. Highest monthly jump since 1998. I mean, it's interesting looking at this chart because it doesn't look like, since the crisis, we haven't even had 1 month where the majority of people see higher stock prices. Even still, it's at 45%.
Right.
No one has believed in this rally, but that is just extraordinary. And seeing a number like that coming as everyone gets bullish, if you're contrarian, you have to take note of something like that. Something else I noticed in the consumer confidence number today, a really big gap in demographics. Look at the difference between how people under 35 felt and people over 55 felt. The blue line is consumer confidence for households with the age of household over 55, surging to its highest level since the financial crisis. Whereas on the flip side, the white line, people under 35, their consumer confidence dives. I mean, this is just the Trump effect right
there. It's still better, though.
It's still better, but this is the Trump effect right here. Under 35-year-olds didn't really like Trump that much. Over 55-year-olds liked him a lot. And you can see it in how they view the economy right now. Younger people have been more optimistic than older people for a long time, but that flip right there is pretty astonishing and tells you so much about what these surveys are really measuring.
So I guess given your chart and given Julie's chart, then people under 35 either don't own stocks and they're not going to own stocks because clearly they're not going in the same direction. My chart is also stock related. Honestly, I'm not a big fan of my chart, but everybody's talking about it, so I figured I'd do it. This is some technical analysis. It's okay. This is basically, I like it because it kind of speaks to the range that we went through this year. Here's what you're looking at. This is basically a candle chart of sorts, OHLC, open, high, low, close. Here's this year. This is the high. This is the low. Look at what happened last year. It's a lower high and it's a higher low. What that means is that this is a quote-unquote outside year. We haven't seen that since down here in 82. And oh boy, well, what did the market do? So listen, there's only like n equals 3 here, right, if this indeed happens. So very little predictive value of this. But it is interesting just to speak to the range that we've had in stocks this year. It's not a bad thing.
And remember how gloomy it looked back in January. Remember we got up to an absolutely dismal start the first several days of 2016. Really plunged into February. And so there's a pretty extraordinary comeback and really speaks to the range of possibilities that we saw this year.
Range of emotions we felt this year.
I don't like the technical analysis stuff usually, but when it has some other broader message, I think it's pretty interesting. All right, up next, Brexit and a Trump victory have propelled stocks to a record-breaking run. Some investors are nervous that stocks may have gotten ahead of themselves, just not those ones over 55. Our next guest says 2016 isn't extreme by any stretch of the imagination. This is Bloomberg.
I'm Taylor Riggs. Let's get to the first word news this afternoon. U.S. Secretary of State John Kerry will speak tomorrow at the State Department on Middle East peace. Officials say the notion that the U.S. orchestrated the United Nations Security Council vote opposing Jewish settlements in occupied territory is, quote, just not true. The U.S. abstained from voting on Resolution 2334 on Friday. Israeli Prime Minister Benjamin Netanyahu sharply rebuked the Obama administration for its passage. President-elect Donald Trump may have to delay plans to dismantle his charitable foundation ahead of the inauguration. The New York Attorney General's office says prosecutors are looking into whether Trump personally benefited from its spending, and the Donald J. Trump Foundation cannot legally dissolve while the investigation is ongoing. The transition team says it wants to erase any potential conflicts of interest before he takes office. A U.S. Navy program that's become a target for critics is preparing to commission a new ship named after a well-known shooting survivor. The USS Gabriel Giffords is scheduled to be commissioned in mid-2017. The $475 million ship will be the 9th in a series of high-speed vessels designed to navigate in shallow coastal regions. Senator John McCain has cited the combat ships as the worst example of wasteful Pentagon spending. Global news 24 hours a day, powered by more than 2,600 journalists and analysts in more than 120 countries. I'm Taylor Riggs. This is Bloomberg. Oliver?
Taylor, thank you so much. Let's get a recap of today's market action real quick. A little bit of green across the equity market, but still not much in magnitude. About 6 basis points on the Dow, so pretty much unchanged after being up a little bit closer to 19,970 earlier. S&P up about 20 basis points, and the Nasdaq doing pretty well. But that's kind of what we've seen, where we have these days in which the tech stocks have done well. What is interesting, though, is that the S&P had been lagging the Dow on some of these daily moves, and now it seems to be kind of flipped as the Dow asymptotes around that 20,000. We'll see if we get there. I don't know. I don't think it's going to happen.
Are we doing a drinking game every time that you say that word
right,
today?
Yeah, that's the word of the day.
What you missed? The U.S. equity markets are on a bull run, with all the major indices up over 20% since their February lows. And with this climb, market sentiment has been on the rise, too. For more on large market trends, we have Bespoke Investment Group's macro strategist George Perks joining us via Skype. George, thank you for joining us. Julie showed the chart in the last segment. People who think the stock market's going to go up next year, it's surging, biggest jump in 1 month since 1998. Are we at euphoria territory with how people see the market, or are we not quite there yet? What's your read on sentiment here?
I don't think we're at euphoria territory yet, Joe, but I do think there has been a very large change in sentiment, both for equity investors and for the U.S. economy as a whole over the last few months. And that definitely, this late in an economic cycle, or this long into an economic cycle, coupled with sort of where you see those previous trends, the example of the Consumer Confidence Index released today, the spread between the percentage of consumers bullish equities versus those bearish is at the highest level since February of 2007, which should be a fairly significant date.
What happened then?
Yeah, exactly. I mean, look, I don't think we're headed for anything like what we saw in 2008, 2009. We would never, try and put a nail on a head for a 40% move like that. I think that said, sentiment is starting to get properly bullish after a bull market that has just sort of climbed the wall of worry consistently for over half a decade now.
Well, and George, speaking of that, stocks have done just fine, thank you, even though sentiment has been pretty low for quite a long time. So we're sort of not used to it anymore because it's been so long since sentiment has been bullish. So what does it mean? I mean, what can we take away from that more positive sentiment?
Well, so the way I think about it is almost from a purely contrarian perspective, right? It's really hard for assets to lose value when everyone thinks that they're going to lose value. And the opposite is also true. When everybody's long stocks, there's no one else to come in and buy stocks. So again, I think we can say without, sounding sort of outlandish or aggressively bearish, we can say that sentiment has started to turn around in a way that it hadn't previously. During the last 7 years or so, there's always been people who can't who think the market can't go any higher, and those people are starting to capitulate finally. At least that's how it looks in a number of the different sentiment surveys. We're not there yet in terms of extreme excessive bullishness like we've seen in equity market bubbles in the past, but the direction and the level are both firmly, I think, now in the camp where the market is quite bullish relative to where it was a year ago or 5 years ago.
Well, Julia, I thought it was interesting in that chart that you brought up showing sentiment versus the S&Ps that, yes, a lot of times, as George points out, it does get pretty, lofty around when the market starts to fall down. But then it's also very bad when the market is just bad, too, right? So basically from 2007 to 2008, sentiment was in the gutter. And obviously, the market stayed there. George, when you talk about sentiment, oftentimes after sentiment come flows. And as we've seen since the election, there has been money flowing back into equities, mostly through ETFs, not so much active managers quite yet. But is there, when you look at flows, is that perhaps a sign that there could be backing to a rally, or do you look at flows from a contrarian standpoint as well?
I think it sort of depends, Oliver. I don't think it's a clear-cut thing. I mean, what we did see after the election, in the month following the election, we saw the largest ever ETF flows into small caps in the history of the U.S. equity markets. Does that necessarily mean that those flows are the wrong people, or are the dumb money, as it were? Not necessarily, but when you see such a huge historical data point following a singular event, you sort of tend to ask some questions. And from our perspective, the election doesn't necessarily have clear-cut bearish implications for equities, but it's not clear-cut everything's going to be great, go buy stocks either. We think the market has been, and as demonstrated by those flows, as demonstrated by investor sentiment, as demonstrated by price action, the market has been very optimistic about what a Trump administration means for U.S. asset prices, and we would strike a more cautious tone. I mean, not again to say extremely bearish, but we're having a hard time reconciling what we think a Trump administration means and what the distribution of outcomes looks like with the price action and what people have done in terms of flows into small caps especially.
George, thinking back to a year ago, we didn't expect that 2016 would be dominated by Trump and Brexit, and we were all concerned, but a lot of people were concerned about high yield and the oil crash. These were the things that were really out of people's minds a year ago. High yield has had a phenomenal year. What are you, moving to credit markets, what do you see as the prospect for that space in 2017?
So spreads are still off their tightest levels of the pre-oil crash credit market spread versus treasuries. At a sector level, it's a little bit of a different story. What we saw is from sort of the middle of 2014 through the beginning of this year, we saw massive spread blowouts in commodity sectors, oil, coal, that kind of thing. And then we saw those compress right back down. And now most sectors are tighter than they were at the tights in 2014. Not all, and the market weighted averages as a whole are not tighter. So I do think we could see some further spread tightening from here. But the combination of a bunch of factors, so the fact that new issuance is coming in at relatively lower treasury rates, so the coupons are lower. The fact that new issuance has come in at relatively lower spread issuance. So if you look at the issuance for the last 5 years, there's just a lot less coupon juice in the indices than there were for issuance that came from 2009, 2010, 2011, 2012. So, we're not negative on high yield here. I think there's probably still some price gains ahead, but there's certainly no chance that we're going to see the sort of gaudy returns that high yield put up this year as a function of the improvement in commodity sectors specifically.
Yeah, I like gaudy returns as as the term for that. I have a chart of this on the Bloomberg, actually, of the Bloomberg Barclays High Yield Energy Index this year. It bottomed in February along with oil prices and then has really outperformed both high yield X energy in blue and total investment grade debt in the U.S. in purple. I know you can't see it, George, but I'm sure you're familiar with the performance that we have seen. Even though maybe high yield is not going to see the same kind of outperformance here, what about energy? Will we continue to see some gains in that area?
It's really hard to say. I mean, I think a lot of that's going to come down to what happens in commodities markets and what happens with OPEC, what happens with the specific microeconomics of the U.S. shale sector's supply function. I mean, these are complicated issues. I think that the energy sector in U.S. high yield was pricing in Armageddon, right? Probably rightfully so, at the end of 2015. It is now not pricing in anything. So we would be definitely much less optimistic on high yield energy here. almost purely as a function of the fact that it's reversed out almost everything that it had priced in and is now looking relatively optimistic. The economics have improved a lot for U.S. producers of crude oil. As a function of the lower prices, it's forced a lot of production discipline in terms of the cost structure across the energy patch. Whether that on its own is enough to overcome the fact that, they're still the swing producer and vulnerable to changes in the prices of oil on international markets as a function of other suppliers is a very open question. So much less room for optimism on energy now than there was even 3 months ago, in my opinion.
All right, George Perks of Bespoke Investment Group, great to have you back on the show.
And coming up, the outlook for food retailers and mass merchants in 2017, according to our very own Bloomberg Intelligence. In the meantime, here's a look at how some U.S. mass merchants have performed so far this year. We've got Walmart with a return of 14%. But besides that, not a lot of outperformance here. Target, Dollar Tree stores, and Costco just up a bit. We'll talk about that and what comes next. This is Bloomberg. What'd you miss? Bloomberg Intelligence has released its 2017 outlook, and every day this week, we're going to take a look at what you can't miss in various sectors for the next year. Today, we're looking at food, retail, and mass merchants, and joining us now is Bloomberg Intelligence analyst Jennifer Bartashis. Jen, mass merchants like Walmart and Target, they're all, of course, fighting Amazon with varying levels, varying degrees of success. How's it stacking up so far in the holiday season, and what can that tell us about next year?
Right. So with regards to the holiday season, things seem to be off to a pretty good start for Target and Walmart. They've had good traffic into stores. They've had a lot of people going online and ordering online and picking up at stores even. And so it does give some confidence that going into 2017, these retailers are on the right track to be able to compete with Amazon.
Jennifer, let's talk about, taxes going into next year. One of the huge issues for the markets. Big retailers have their own specific concerns. Walmart obviously would not like to see anything that limits imports because they sell a lot of imports. How important is the overall tax situation, and who do you see are the potential winners and losers from tax reform?
Yeah, that's a big topic that everybody is thinking about. And when it comes to the mass merchants, actually Walmart is probably less exposed than its peers. And the reason for that is they sell so much food. Over 50% of their revenue is from food. And that's mostly produced domestically. And that means that there's the ability for them to then continue on and fight against, and they can actually battle against other retailers, whereas Target, which is a lot less reliant on food, has a much larger problem with dealing with imports and the tax consequences thereof.
So, Jen, I'm looking at this chart from your Bloomberg Intelligence report. It's pretty interesting because basically it shows that year to date the S&P 500 is, has gained, but there's basically been a big rally in the mass merchants, and then they kind of dropped off.
Be able to hear us. I think she's inadvertently unplugged herself.
Oh,
Jen, can you hear us?
So I've got this chart up right here. And basically what you're looking at is the S&P 500 in the blue. We know what it's done year to date, but then the mass merchants had this big rally, and now they're kind of coming back down, which is, if I thought that the, post-Trump rally was based on the American consumer doing well and pro-American and all this stuff.
You guys, she can't hear us. I saw her
I've got the chart here, so we'll talk about it.
Let's talk about the chart.
I mean, basically what the point of the report is that, listen, there's a lot of questions out there because there's sort of a churn that's happening in the retail mass market space where there's bankruptcies, right? There's M&A happening. And at the same time, you have this sort of idea that America's supposed to be, put forefront post-Trump, and there's going to be GDP growth. But for some reason, since the election, these stocks haven't done so well. The white line here is basically showing this index of mass merchants. I think it's pretty interesting because there's a story about the consumer. There's a story about how the sort of American growth story is going to be forefront. But you have to keep in mind all the idiosyncratic type of stuff that's going on within these companies where they're trying to compete. And guess what? Some of them are dying off. Some of them are merging. It's making smaller, fewer and fewer companies that are dominating the space.
Well, and we were just looking at, going into the break, at a chart of the mass merchants. Walmart, the clear outperformer this year versus Target, for example. But it, too, has not really changed since the election. So that's something that we'll be continuing to keep an eye on. Also, we are watching what's going on right now in Hawaii. President Barack Obama and Japan's Prime Minister Shinzo Abe, they're participating in this wreath-laying ceremony aboard the USS Arizona Memorial in Pearl Harbor. That memorial honors sailors and Marines killed in the 1941 attack by Japan. And remember, Abe's visit being cast as a gesture of reconciliation, matching President Obama's trip to Hiroshima earlier in the year, both of them the first since World War II by the respective leaders of the two nations. So a historic event here as the two do go to that memorial on the USS Arizona.
All right, and up next, Deutsche Bank's David Bianco and his call for the S&P 500 next year. This is Bloomberg. What'd you miss? Well, there are still a few trading days left this year, but we're already looking forward to 2017. On Bloomberg Daybreak America's Deutsche Bank chief U.S. equity strategist David Bianco discussed what needs to happen in order to reach his S&P 500 target of 2,400 in 2017.
A corporate tax cut, and that's crucial to getting to a number like 2,400. And I think investors in the new year are going to be, hungering for details on this tax package, even in the first several months. So I think whether the S&P gets over 2,300 or revisit something under 2,200 in the early part of next year really depends on how that legislation starts taking shape.
So you've got your forecast, and there's this asterisk on the corporate tax cut.
Right.
But on the asterisk with the corporate tax cut, how do you make the calculation, given that you've got the official corporate tax rate signed into law, then you've got the effective tax rate for some of these big multinationals on the S&P.
And that's been the key question with investors and analysis for the past few weeks. We've been talking about a scenario of the U.S. statutory rate going from 35% to 25%, a 10-point cut. 60% of S&P profits come from the United States, so we're arguing that there should be a 6-point reduction in the effective tax rate of the S&P from about 28 to about 22%, and that makes the S&P go from keeping 72% of its profits to 78% of its profits, an 8-9% boost, $10 per share.
So, David, in that effective tax rate, you also take a look at how they're going to pay for this tax.
Right.
cut.
That's well.
Because there are reports right now, because Paul Ryan has had plans out.
Yes.
For example, they're talking about things like eliminating the interest deduction.
Yes.
So that might really make a difference between companies about whether it flows to their bottom line or not.
Right. Well, part of the reason why we're doing our analysis with that 25% corporate tax rate rather than going as low as 15 or 20 is that it helps us to argue that, well, if there are things like a loss of net interest deduction, well, you probably do get an even lower tax rate than 25. I still think you get a net benefit of $10, almost under the major scenarios proposed. However, you're right. Figuring out who the winners and losers are is a lot more complicated on the details of the proposals. I think in the end, because the complexity, particularly around things like net interest deductions and border taxes, I think they're going to end up finding that they need to keep it simple and just drop the tax rate to something that's in line with the OECD average. And it's not going to be revenue neutral in the first couple of years, but I think over a 10-year period, it can be.
Let's get the David Bianco forecast tax rate cut.
Yeah.
What is it?
Well, I think you would have the S&P only be about 2,300 by the end of 2017, and with the risk of, even a good solid 5 to 10% decline on the disappointment.
In this market, though, and the S&P 500 maybe less so than the Dow, is a euphoria around fiscal stimulus too. How much do you have to pay attention to that, and what's the likelihood we actually get it in a significant material way?
Right. I mean, so the deregulation and the infrastructure spending and the tax cuts from corporate to personal are all part of this package here. I do think the corporate tax cuts by far are the most important. There's a lot of excitement around the infrastructure, and you pick your number, $1 trillion. The point is we talk to investors and point out that the U.S. does $250 billion a year of infrastructure spending, and I think it's going to be very difficult to get that over 300.
So take us below the overall top-line number. Differentiate among sectors as you look into 2017. Who are the winners? Who are the losers?
Well, look, the earnings will be $119 in 2016. One of the big sources of earnings growth in 2017 should be the energy sector. I'm expecting about $55 average oil. That should add $6 to S&P earnings by itself. Take the S&P from that 119 to about 125. Excluding energy and financials, and before the tax cut, I'm expecting only 5% earnings growth. And that's basically the same 3, maybe 4% sales growth, flat margins, some share count shrink.
We've had a huge adjustment over the last month. You're bullish ultimately on the index for next year, but where do you think, on a sector basis, have things got away from themselves?
Well, look, I think the sectors that are about reflation or aggressive cyclical rotation and energy, industrials, materials, this infrastructure enthusiasm, I think that's overblown, and I'm underweight energy, industrials, materials, and I find myself actually bearish on them, even despite what I think would be a rising market overall. Where I agree that there should be an acceleration, improvement in profits, and the cyclical that I like a lot, financials, we still see upside, and healthcare. That's a sector not to be ignored given the valuations and strong structural trends.
That was Deutsche Bank's David Bianco there with Bloomberg Daybreak Americas.
It's time for the Bloomberg Business Flash, a look at some of the biggest business stories in the news right now. The U.S. is investigating some Ford Fusion and Mercury Milan cars because the brake pedal may lose pressure, making it hard for drivers to stop. 3 crashes were blamed on the braking issue, according to the National Highway Traffic Safety Administration. Officials say there were about 475,000 of the vehicles on the road. Ford says it's cooperating with the investigation. Airbus's struggles with its A380 Super Jumbo jet are deepening. The plane maker says it's delaying deliveries of over a dozen aircraft over the next 2 years to Emirates, the double-decker's biggest customer. To make up for the financial drag, Airbus will accelerate cost cuts. And UPS expects to deliver 1.3 million packages back to retailers on January 5th as the delivery service celebrates what it calls National Returns Day. And if UPS is right, it will be its busiest returns day ever, topping last year's 1 million. Next week, the company says it expects almost 6 million packages to be sent back. And that's your Bloomberg Business Flash.
Coming up, what you need to know to gear up for tomorrow's trading day. We'll give you the events to watch. This is Bloomberg. What'd you miss? Well, we did have a record for the NASDAQ composite today, actually, and the Dow got a little bit closer to 20,000
You're
once
digging
again.
deep there.
It got close, and then it came back, and then it got close, and then it came back again. What's the word?
Asymptotic. That's the word of the day. The Dow is becoming asymptotic at 20,000.
In the meantime, don't miss this. Tomorrow, we're going to get the report on U.S. pending home sales for November. That coming out at 10 a.m.
And I'll be looking at Italian consumer confidence, which comes out at 4 a.m. Eastern time. We'll see how some of the recent events affect the consumer there.
And also in Europe, we've got retail sales coming out in the European Union at 3 a.m., so make sure you're awake for it.
We all will be, I'm sure. That's it for What You Miss. Thanks for watching.
Have a great evening. This is Bloomberg.
I'm Taylor Riggs. You're watching Bloomberg Technology. Let's start with a check of your first word news. Shinzo Abe will become the first Japanese prime minister to visit the USS Arizona Memorial and the first Japanese leader to visit Pearl Harbor with an American president. Abe began his trip to Hawaii today by placing a wreath at a military cemetery. Secretary of State John Kerry will speak tomorrow at the State Department on Middle East peace. Officials are denying talk that the U.S. orchestrated the UN Security Council vote opposing Jewish settlements in occupied territory. The U.S. abstained from the vote Friday. And Israel plans to continue construction in the contested area. The Municipal Planning Committee in Jerusalem tomorrow will review requests for hundreds of apartments. Meanwhile, one of the President-elect Trump's main advisors on U.S.-Israeli relations will be his special representative for international negotiations. Attorney Jason Greenblatt, who is Executive VP and Chief Legal Officer of the Trump Organization, has been named to the role. And actress Carrie Fisher, who played pop culture icon Princess Leia in the Star Wars movies, has died. She had been hospitalized since Friday when she suffered a medical emergency on board a flight to Los Angeles. Carrie was 60 years old. Global news 24 hours a day, powered by more than 2,600 journalists and analysts in more than 120 countries. I'm Taylor Riggs. This is Bloomberg. Bloomberg Technology is next.